Fastball in 2007, 110 trades. So this one came up 110 times in my trading service. Of the 110 trades, 61% of them went to the profit target or better and generated 27 points in profits. Is everybody comfortable talking in points as opposed to percentages? Yeah, okay. I mean, you just multiply the points by the number of shares, right? If you're 27 points, if you're trading 1,000 shares, $27,000, divide that into the amount in your account, that's your percent return. So if you got a $100,000 account, that's a 27% return on one trade. The reason I don't report percentages is what you typically see is, guys who are reporting percentages will tell you, well, it was a 400% return on equity. Well, if you only have $20,000 in the trading account, then your percent return goes up very dramatically, and it's kind of easy to monkey with the numbers. These are all just exactly the way that I trade them and exactly the way that I record them for myself, which is then in points. The setup, we're going to talk about two of these. There's a bunch of ways that a fastball setup can happen. The ones that have been happening recently involve trending stocks that pull back and then essentially break out. So what we want to see on this one is you got an uptrending stock or a downtrending stock, pulls back for a few days, could be 3 days, could be 5 days. As long as I see a nice pullback in the direction of the trend that doesn't retrace more than, say, 50% of the original move, I'm interested in it. And then we get a move that pops out of that pullback and gives us the widest range move of the last 10 days, so 2 trading weeks, and also gives us the largest volume that we've seen over the course of that pullback. So the volume on the breakout bar should definitely be stronger than the volume that generated the pullback. And on the trigger day, our entry is going to be, so for a long, it's going to be 10 cents above the high. I used to use an eighth, right? I've been around that long, unfortunately. And, back in those days, an eighth was just a confirmation number. A dime, we're using a dime because it tends to, some guys who are trading my stuff, they like to get in a penny in. It gets a penny above that high and they want to take it. For me, the dime manages to wash out some of the volatility, right? Because the thing's not breaking out fast enough. Guys who bought it yesterday are looking to sell it into the order flow, whatever. You don't want to be there for that. It's great if you can just let the stock sort of naturally pick up some momentum. And 10 cents tends to get you through the selling or buying that might contravene the trend. By the end of the day on this one, I've always closed the position. Fastball is a volatility setup. I never recommend taking this one overnight. My switch hitter setups, those kind of things, those are longer-term trades. I'll hold them for a while, but the fastball tends to get you in right off the open. There's a lot of volatility right off the open, and if it does get you in, you tend to get your money in 10 or 15 minutes, and a lot of times you've got opportunity for second entry, and I always take second entry on my trades. So first entry and second entry, general rules for any of these trades are going to be, if they go 10 cents in my favor once I'm in, the trade's on. If they go against me before they go 10, if they go 10 cents against me before they went 10 cents in my favor, I'll scratch the trade, look for another entry. All right, because especially on the volatility setups, if they start going against you right away, it's better to just cut them loose and look for another entry. Once we get 50% to the profit target, ratchet your stop up from the original stop on the trading plan, ratchet it right up to break even. Once you get to the profit target, if I'm trading for myself, if we're talking about like 1,000 shares or something, I'm liable to just parse this thing off right at the profit target. If I'm trading for the fund, I might be looking to just parse shares and try to let profits run some, because if you have more shares, it's obviously advantageous to try to get as much out of the trade as you can on the day. Here's what this one looks like. Assume that this was an uptrend. Nice, that this is less than a 50% pullback or whatever happened down here. This area labeled 1 is your pullback. The bar labeled 2 would be the pop, the fastball pop, and the bar labeled 3, 10 cents above this high here on bar 3, we're getting into the trade. I've got a chart that actually shows this on Aetna a while back. I borrowed the big blue arrow from my buddy Landry. So you got an uptrend followed by a pullback. Then you've got the range expansion day, the fastball bar. Now, the other thing about this is I want to see that range expansion bar close in the top 25% of the bar if it's a long, bottom 25% if it's a short. I want to see order flow into the close. So preferably if the thing picked up momentum going, in the open and it got up to a high level off the open, I want to see a lot of buying going on going into the close. I want to see shares going off. I want to see that something that somebody was trying to get done didn't get done. And in the morning, what I'm counting on doing is hopping on board when they try to finish up the buying activity in this case. So here's actually what one of my trading plans looks like. It's recent. This is a couple days ago. This was XTO Energy. I always give myself the chart. I've just got a stack of these things on my desk in the morning. Usually I've got like 3 trades going on. I mean, I don't do a lot of trades compared to, yeah. No. Yeah. Yeah. It's my setup on it was just okay. I've got the position identified. Right. My entry was 54 and a quarter. I'm not really looking for giant moves on these. I'm trying to capture just the quick volatility play. My initial target was 55.16. That's based again on the price action on the daily chart. The stop loss was based on 5-minute support and resistance. My ratio on the trade, 2.07 to 1. And 50% to the target was 54.71. So when the trade gets to 54.71, what do? We move the stops up to break even. Right? So at that point, it's a risk-free trade.